Welcome back, everyone. It's Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today, we have a great topic that came from Emily O., who says, I've been listening to the Money Girl podcast for about 5 years and always learn so much. It makes my commute home so much more exciting. My mom is 78, very healthy, and lives independently. She receives $1,000 monthly from Social Security and has a retirement account balance of about $420,000. Her financial advisor brought up the idea of buying a single premium immediate annuity. It might cost from $130,000 to $200,000 and would pay in the range of $1,000 to $1,400 monthly. What are your thoughts on annuities? And would you recommend one for someone in my mother's situation? Emily, thank you so much for your kind words and great question. This podcast will review what a single premium immediate annuity is, how it works, its pros and cons, and who should consider buying one. Welcome back, everyone. Thanks for joining me. I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of the Money Stack newsletter, and host of this show, Money Girl, with over 43 million downloads. My mission is to help you get the knowledge and motivation to prioritize your finances, build lots of wealth, and have more security and less stress. Be sure to follow Money Girl on Apple Podcasts, Spotify, or wherever you're listening to podcasts so you automatically get each new episode. And if you have a question you'd like me to cover, I would love to hear from you. You can leave it on our voicemail at 302-364-0308. You can also send me an email using my contact page at lauradadams.com. And while you're there, be sure to sign up for the free Money Stack newsletter. All right, what is an annuity? Before we discuss the specifics of a single premium immediate annuity, or SPIA for short, let's review some basics about annuities. An annuity is a contract between you and an insurance company that guarantees to pay you certain financial benefits, like never running out of money in retirement. Annuities are sold by licensed professionals through insurance companies, banks, brokerages, and financial advisory firms. Since fewer Americans qualify for a lifetime pension from an employer, an annuity can definitely complement your retirement savings and your Social Security retirement benefits. In fact, Social Security is the ultimate annuity because it pays qualified recipients a lifetime, inflation-adjusted, monthly retirement benefit that's guaranteed by the federal government. But let's say you retire and you find that you need more income, or maybe you're just afraid of outliving your modest savings, or you're concerned about the effects of future inflation, or you're worried about your future cognitive health, or maybe you expect to live a really long time. In all of those situations, an annuity can be an excellent solution. So let's talk about a couple of main types of annuities. There are two main types based on how you fund them. So we have flexible premium and single premium. With a flexible premium annuity, they allow you to add funds over time. It could be monthly, quarterly, or annually, according to any schedule you wish. And there are single premium annuities. They require you to make a one-time lump sum payment. So whether we're talking about a flexible or single premium annuity, you can choose to begin getting an income from them right away or in the future. So if it's right away, it's called an immediate annuity, and it starts an income stream as soon as 1 month after your contract's issue date. Or you can have a deferred annuity that allows you to begin receiving income at a future date. The payout doesn't begin for at least a year after your last premium payment, but it may be deferred by as much as 40 years. When you're shopping around for an annuity, there are lots of variations. You're going to find lots of customized options known as riders. These give you additional benefits for an added cost, and they're really important to understand because they can totally alter how this product works for you. So let me go through a few kind of typical common riders that you're going to see. One is called a death benefit. This ensures that your beneficiary receives any annuity balance after your death. There are long-term care riders. These increase your annuity payments to cover costs either for care at home or in a nursing facility. There is a terminal illness rider that allows you to access some or all of your annuity balance without paying an expensive early surrender penalty if you get diagnosed with an illness that gives you a shortened life expectancy. There's a cost of living rider that requires your annuity payments keep pace with inflation up to a preset cap. And there are others, but those are some that you'll probably see the most often. So let's talk about how a SPIA works. A SPIA is one of the most simple types of annuities. You agree to pay an insurer an upfront lump sum, which is the single premium. In return, the annuity provider agrees to pay you an immediate stream of income, and that's known as annuitization. The series of payments you receive from a SPIA could be for a specified period, or it could be for the rest of your life, depending on the option you choose. As I mentioned, your payments can be fixed or adjusted annually, such as for inflation. You'll have a guaranteed income stream no matter what happens in the financial markets. Emily mentioned that her 78-year-old mother could buy a SPIA from $130,000 up to $200,000 that would pay her from $1,000 to $1,400 monthly for life. The income you receive from an annuity depends on your age, gender, home state, and the interest rate when you buy it. So let's suppose Emily's mom were to purchase that same annuity 18 years ago when she was 60. In that case, she would have had a longer life expectancy and the annuity would have paid her less. Or let's say she had a shorter life expectancy due to a terminal illness. In that case, the same annuity would pay her more. So this shows you how important life expectancy and your age is when buying an annuity, and this is typically why they're usually bought by older people. So think of an annuity as the opposite of life insurance. With a life insurance policy, insurers charge older people more because they're more likely to die sooner rather than later, triggering a payout to the insured person's beneficiary. But with an annuity, insurers guarantee higher annuitization payments to older people because they are likely to die sooner rather than later. So let's talk about how taxes work on a SPIA. Emily mentioned that her mom's money is in a retirement account. You can purchase any type of annuity using money inside or outside of a qualified retirement account, like an IRA. When you own an annuity outside of a retirement account, it's called a non-qualified annuity. So in that case, you have to pay a non-qualified SPIA premium on an after-tax basis. Then your payments are going to be made up of both principal, which will be tax-free, and investment earnings, which gets taxed as ordinary income. So a portion of your annuitized payments will be taxable. But owning an annuity inside a retirement account is called a qualified annuity. So that means it's subject to the retirement account rules. For instance, owning a SPIA in a pre-tax traditional IRA means your premium is tax deductible, but your payments get taxed as ordinary income. You can also own a SPIA in an after-tax Roth IRA. In that case, your premium would be paid on an after-tax basis, but your income payments would be entirely tax-free. So again, the rules apply, just like they do to other money in a retirement account. So let's talk specifically about the pros of a SPIA. A significant benefit of buying a SPIA is that you shift a portion of investment risk to the annuity provider. As I mentioned, no matter what happens in the financial markets, the annuity company is contractually obligated to pay you a guaranteed income. Therefore, instead of having to invest that single premium amount that you paid to the annuity company, instead of having to, manage that yourself in a potentially volatile financial market, you're simply purchasing an income stream. You're leaving all the heavy lifting to the annuity company. Turning a portion of your savings into secure lifetime income from an annuity doesn't mean you're going to get the highest possible return on your investment. But it does mean that you no longer need to be concerned about investing that portion of your portfolio. In addition, if you have a long life, the annuitized income payments could add up to be greater than the single premium you paid to purchase a SPIA. Okay, what's the downside of a SPIA? Every financial product has its downsides, so you need to be well aware of them. A con of buying a SPIA is that you agree to pay money to an annuity provider that you typically can't get back without paying a significant penalty. That could be a problem if you suddenly need the cash, let's say for healthcare or long-term care expenses, unless you purchased a long-term care rider. Remember, I mentioned those would give you a higher payout. Buying an annuity may also mean you leave a smaller inheritance to your heirs. Remember that you or your heirs don't get the single premium back unless you choose a product with a death benefit rider. Plus, if you die sooner than expected, the single annuity premium could be much larger than the income stream you receive while you're alive. However, again, by purchasing an add-on such as a death benefit, you could ensure your estate doesn't lose money on a SPIA. Also, as I mentioned, you may not receive a return on a SPIA that's as high as other investment options. You must be willing to give up control of your funds in exchange for a certain amount of guaranteed income. So, who should buy a SPIA? Well, with stock market investments, you may receive higher returns than with an annuity. But those returns are never guaranteed from the market, right? So owning one or more annuities ensures you can survive a long retirement, even if the market drops. Emily's mom is likely a good candidate for a SPIA based on having a fairly modest savings balance and fairly modest Social Security income. If she's worried about outliving her money, SPIA payments can give her a monthly check and perhaps a more comfortable retirement, no matter how long she lives. As I mentioned, if you buy an annuity and live a long life, you're going to get a great bargain. But if you live a short time after annuitizing, the annuity provider wins, unless you opt for a death benefit rider. Annuities can be a terrific addition to your portfolio if you want the simplicity and peace of mind of additional guaranteed monthly income. But since there's a lot to consider, including taxes, estate planning, and various riders, please consult a qualified financial advisor about whether a SPIA or any other type of annuity fits your retirement strategy. Carefully review the pros and cons of different annuities and riders with your advisor, and consider getting a second or third opinion if you're unsure about the annuity type or amount that's best for your needs. Emily, thanks again for sending in your question, and I wish all the best to you and your mom. Before we go, I want to invite you to subscribe to the free Money Stack newsletter. It's my newsletter that goes out 3 to 4 times a month that is filled with money tips, tools, news, challenges, and invitations to live educational events. I hope to see you there. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our fantastic team. Steve Rickyberg audio engineers the show. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.